Greetings, everybody. We are back with another commentary video. I'm changing it up this week in lieu of a blog. I was doing my usual weekend reading and came across a few graphics, a few charts that caused my jaw to drop. And I thought, let's switch it up. Let's share these, provide some context, because this is such an odd market, and I want to capture some of the oddities that we're seeing that are unlike any I've seen in my 20-year career. So I'm going to share my screen. Hopefully this comes through okay. This will be like a mini commentary exercise, and let's go. All right. So I'm calling this Latte with Nick. That's kind of a tongue-in-cheek spin-off of Sunday Coffee Reads. It might be a stupid name. I don't know. And again, these are just a few charts going deeper into some themes that I've covered in the past relating to not only the sheer size of some of the top performing companies in the S&P, but how that stacks up with some other indexes, some other stock indexes that might be out of favor. And some of these relationships are at historical extremes, and we'll get into some of the dynamics specifically between some of the large cap tech companies, how that's changed over the last 10 years versus smaller cap companies. If I didn't see it, I wouldn't believe it, and that's true. So let's go. So what you're looking at here in the left column is the 25 largest S&P stocks 10 years ago, so roughly 2013, versus the 25 largest S&P stocks today. And I know sometimes I talk fast. I would encourage you to pause this and just to look and compare who the big players were back in 2013, what their market caps were. And market cap is simply number of shares outstanding multiplied by the price per share. It's a measure of the size of the company. So the larger the market cap, the bigger weighting in the S&P, and the more influence these large companies have on the indexes, in this case, the S&P's performance. So you can see Apple is the same, but these large crooked numbers get even more large and more crooked over here, going from roughly a shade under a $500 billion market cap to almost $3 trillion 10 years later. And you can see some of the other names at the top are the same. They might have shifted around. But what I take away from this, and your takeaway might be different, is the sheer size of the top 25 companies as a percentage of the overall index. And you can see these sums here, almost 3.5 times the size, meaning if you did not own some of these high flyers, you probably trailed pretty badly. And there's some other nuggets here as well. So I'm going to move. Okay, so the other thing that sticks out here is the 10 largest companies back in 2013 accounted for roughly 10% of the S&P 500 index. Fast forward 10 years later, the biggest 10 companies account for 25% of the S&P. So let that sink in. So the top 10 companies make up overwhelming share of the S&P index today versus 10 years ago. And look, a lot of these companies are great. They've made money. Investors have made money. It's just very top heavy, which can be a blessing and a curse. If these stocks keep going up, it almost creates a momentum index for a passive investor, right? You're buying the S&P 500, you're buying more of what's doing well and less of what's doing poorly. And that works great, again, if these stocks keep moving higher. On the other side, a lot of analysts and experts are wary of the fact that much of the S&P's performance is explained by a handful of companies. So a bad earnings report, you have single company risk if something goes awry, where one of these companies falling back down to earth could have a pretty sizable impact on the index. So it can make things good if they keep performing, but it also can make things rather concentrated and fragile if one of these companies has an off quarter or lowers guidance or something to that effect. So this was the chart I shared during the last market commentary, and I'm not going to spend too much time on this, but just a refresher, this is essentially the NASDAQ composite divided by the Russell 2000. Okay, and the Russell 2000 is a US small cap index. Of course, the NASDAQ is an index of technology companies. So The higher this line goes, the more extreme technology stocks are trading relative to US small cap stocks. So just to use, to shock the values. So when NASDAQ stocks, when tech stocks are performing well and US small cap stocks are performing poorly, this ratio will be higher. And that's what's happening now. This is where we're currently at. And you can see this extreme reading of this ratio is only rivaled by the tech bubble back in 2000. Like I said in the last commentary video, that doesn't mean we're going to get a tech crash. Certainly the dynamics have changed. I pointed out that a lot of these tech companies are really profitable, spinning off cash flows, and are leaders in their field. That wasn't the case back here. But the point holds that looking through history, looking over the last 40 years or so, technology stocks are out of whack relative to US small cap stocks. So one of two things can happen. Either tech stocks come back down to earth, US small cap stocks go up in value, or a combination of the two. But this, looking through the historical lens, is probably unsustainable. That's a really good segue into some of these last charts I'm about to show you. Okay, so this is from the University of Chicago and Bespoke Investment Group. And this is this is really confounding to me. So this goes back to the 1930s. And as I move to the right, we go all the way up to current day. And what this is, this blue is small cap stocks, the US small cap stocks, as a percent of the total US market. Okay, that includes US large, mid, obviously small caps. So every publicly traded company in the US. And we're measuring small caps as a percentage of the total market. I know small caps have been out of favor, but when you look at this through a historical lens, I mean, this is beaten down territory. You have to go back to the 1940s to get to similar levels as a percent, small cap as a percent of the total market cap. And this simply means small caps have been deeply out of favor, and again, only rivaled by the Great Depression and the 1940s. And this is also, on the other side of this, is, you know, as US large cap stocks keep going up, small caps can remain flat and still be a smaller percentage of the total market. So this is two extremes. US large cap stocks going up, small cap stocks having a rough go of it, creating this huge, historically unprecedented gap between small cap as a percent of the total market. This is where small caps usually trade at, this brown line as a percent of the total market. So you can see this white space represents a major gap. And if you're a believer of reversion to the mean, this being the average or the mean, you might find small caps to be attractive here, and you might expect them to go up in value. But again, that's not a promise on what happens next. But, you know, if you're a forward-looking investor looking at the opportunity set out there, small caps are certainly out of favor and could be one potential place to look for an opportunity. Finally, I don't know if the last graph or this graph made my jaw drop more, but what this shows, this goes back to January 2018 all the way up to last Friday's close. So the blue line is the Russell 2000 market cap. All right, so an index of US small cap stocks, Russell 2000. The red line is Apple's market cap, and the gray line is Microsoft's market cap. Microsoft and Apple are worth more than all 2,000 companies in the Russell 2000 index. So just let that sink in. These two companies, each company, Apple and Microsoft, are worth more than the Russell 2000 index. That's not combining Apple and Microsoft. That's standalone. So Apple by itself is worth more than all 2,000 US small cap companies. And I say small cap, these are, I think what defines small cap is revenue between 500 million, or excuse me, market cap between 500 million and 5 billion. So I'm saying small. These are not small companies. These are fairly sizable companies that Apple and Microsoft by themselves are bigger than. And you can see that has not been the case over the last 5 years. You can see the combined market cap of the Russell 2000 has a pretty decent lead over Apple and Microsoft. There's been a couple narrowing of the gaps here, but this has converged, and Microsoft and Apple have overtaken the Russell 2000 index. So again, no absolute conclusions. This is just a snapshot of how disjointed and how unbalanced this market is, where the winners keep on winning and the losers are just deeply out of favor. Now, I'm filming this on Tuesday, November 14th, and small cap is staging a massive rally. So this could change, and it could change quickly, or this could continue going forward. But I have never seen anything like this where one group of companies, in this case US small cap, are so out of favor relative to a handful of mega cap tech stocks. So let me know what you think of the new format. I'm happy to do this again. Thanks for watching. Thanks for listening. I'll see you next time.